Well, thank you so much for being in our webinar today. It is almost 6 o'clock. We are just about to start. And I think it's a really nice day to be talking about, let me just see myself here. It's a nice day to be talking about the market with everything that is going on these days. So that's why we prepared for you, especially this webinar about what's going on in the markets. And then we can definitely see um, well, some ideas on how you can prevent of making the usual mistakes that most of the clients could be having these days or the investors could be having these days. So as you know, I'm a financial advisor, but in this presentation, all the information that you're going to receive is just going to be for educational purpose only. We are not going to give you any investment advice here. Everything is for educational purpose only. And as you know, I'm not trying to offer you any kind of product or anything like that. Always consult with a specialist or your financial advisor. If we start from here after reading this, for those of you that don't know me, hi, my name is Alonso. I am a certified financial planner. I have been in the industry for the last 25 years. And recently, well, in the last year, Investopedia named me between the top 100 financial advisors. ETF did that the last year. And in this year, Go Bank Rate named me between the top 100 money experts. That's just for you to know who am I. And let's go and talk a little bit about what you're looking for, about the markets, what's going on in the markets these days and these uncertain times. I was just collecting some different, I mean, titles from Yahoo Finance these days, and we can see different, things going on in the news, like expectations for economy are not looking all right, consumer confidence stumbling. Actually, I took this one from today. Today is March 28 in 2025. The stock has tanked, they plunged. There is some inflation fears. There is a people are selling some of their stocks in tech. But when we read all that information, maybe we're starting to get afraid because we definitely feel that this time is completely different from other times. We can maybe be thinking like, what is going to happen with the economy in these years? What about the tariff? What about the inflation? What about all the migration problems and all that? And some people can be thinking, what is going to happen with my investment portfolio? But also when we are reading that information, we see that it's not that clear that a recession is coming, but we are now hearing that word about recession. The consumers are not feeling confident about the future. So let's share some knowledge here. So like what's going on to happen in the future and what should be the kind of mistakes that you should be avoiding. And let's start with the first one. And I know it feels like maybe the first mistake here will be panicking, feeling like you have to go and sell your positions, or maybe you are going to feel like, oh, I have to just, I don't want to be in the market for the next years, or I should just sell all my stocks and things like that from my retirement plan, from my brokerage account. I would like to bring here this quote from Sir John Templeton. And he says that the four most dangerous words in investments are, this time is different. Sir John Templeton mentioned this quote in 1939. And I'm bringing this quote especially today because it certainly feels different. It's like for most of us, we'll be saying like, maybe this is completely different from what we have seen before. And maybe we're just feeling that really feels different this time. But let me bring this information. It's like, this is the S&P 500, from the 60s. And as you can see in all these years, this is just like whatever amount you invested it here. You see that from all these years, we have been going, for a lot of things here. If you remember here, the Cuban missile crisis, Vietnam, Nixon, the Black Monday, the Gulf War, the dot bubble, September 11, the Y2K and Iraq, housing crisis, Brexit, COVID. it really feels like each time that people have been living all these situations, maybe they have been telling, oh, this really feels different. I mean, like this, I mean, it is completely different. And we could go here. Maybe most of us are saying this time feels different. But as you can see in all these years, if you just hold your investments for all these years, you can see that the percentage of return annually was like 10% on average for all these years. So what I'm trying to bring here is like, as you know, I'm not going to make any political comments here in this webinar for you, but I know it feels different, but it's not that different from other things that we have been living there. Maybe if you ask for someone like that was living, I don't know, the Cuban Missile Crisis or the Korean War or something like that, they can definitely tell you that he was feeling different. Or maybe when we got into COVID, which was more recently. I mean, we were feeling that there was the end of the world, the end of the population, I mean, the humanity as we know it. In this time, we can be feeling that same way, but let's keep reading other ideas here. I'm bringing this graph because I really love the way, I mean, this is a graph from Edward Jones, and it shows us something like this. Until now, in 2023 and 2024, we can definitely say that we have been having great years. I mean, like 2023, the returns were really high. In 2024, the returns were also really high. And now in this 2025, maybe it doesn't seem like that. So maybe we were going like this in this graph. Like first, we were feeling really optimistic, like the market is going up, and maybe we are having two of the best years before this one. And we were like, wow, this is great. I should be investing more. And as you see the way that most of the minds of the investors works, it doesn't work like, oh, it's getting cheaper, let me go and buy more. No, it works the other way around. It's like the markets are going up, everybody's making a lot of money, and I don't want to feel that fear of missing out. I want to be there. I want to have the opportunity to earn some more money. So most of us will in 2023 and 2024, maybe here. And when the markets started to fall this year, maybe in this February or March, maybe you will say, oh, it's okay. I'm a long-term investor. I'm not here for the short term. And like this money is for my retirement, so I'm not worried about it. I'm already retired, and I know like I'm gonna be retired for many, many years there. But then the fears comes because you start reading news like the one from today. Like the market is plunging, the inflation is there, the recession is coming, and things like that. So you start saying, oh, maybe this time is different. And we know that word from Sir John Templeton. That's the most, dangerous words that you can be telling to yourself. Because then you go here and instead like, oh, I'm gonna sell my positions. And then you did it all the way around. You bought your investments when the market was at the highest one, and then when it goes to the bottom, you just go and sell your positions there. And then when the markets start to go up again, maybe you said, I don't feel the markets are going to go up again. And the real way that you should be working is the other way around. Remember, if you are here, you should be rebalancing your portfolio. We are going to talk about that more. So one of our first mistakes here will be panicking, feeling that these times are completely different from whatever else the humanity has been living before, and also going to sell when the markets are their worst moment because you feel that it's going to even get worse. If we can read in here, I brought you this graph. It was from today. This is just like the way this S&P 500, as we know, the biggest 500 companies here in the US is behaving. And you can definitely see here that from the beginning of the year, those 500 companies, this index here, has been going down like that 5% here. So it really seems like, wow, I'm losing money here. But if we start just remembering that maybe this money is not for the short term, because if it was for the short term, you should not be investing that money in the stock market. Maybe what we can see here is like, well, um, you should be investing in a long way. And when you say that in a long way view, we can definitely see that this other graph is just as S&P 500, the same one, but in a 1 year period. And when you see it in a 1 year period, you can see the line here, this green line going up. We can definitely say that the market until now is still positive from 1 year. I mean, from if you take the information from 1 year before. So we can say that until now, the stock market is still at 6.20% up. In this year, maybe in 2025, it's not. But if you can keep, I mean, moving behind and just to check what happened in the last 5 years, in the last 5 years, the return of the S&P 500 is 119%. So be careful also with just reading the information from the short-term view. Yeah, they can make you really afraid. You can get, I mean, you can feel panic there. You can feel that maybe I have this fear and I have to surrender. I have to sell my positions. Because if we see it like this, the longer you stay in the market, the more protected that you're gonna be there. I know that this time really feels different because we have the AI, we have the president, we have other things here in this moment happening. But what I'm trying to say is the only resources that we have is just to look a little bit about what has happened in the past and bring that knowledge to the present days. We run these numbers, it's like, oh, the odds for you of winning if you start panicking from 1930 to till these days. And you can definitely see in this first bar here, like in just 1 year, your probabilities of losing money in the stock market could go beyond like this 30%. But if you hold that money for more than 3 years, the probabilities start to go down. Now we are talking about 23%. And if we keep moving that, I mean, that same number here, and we go for 5 years or more than 10 years or more than 15 years, you can see that when you run the numbers, there is no probability of losing your money in a 15-year period and not even in a 20-year period. So if you panic in the market and you jump from the airplane, that's where you're going to get hurt there. But if you hold there, I mean, that's really going to help in the long run. If we go and check here, we also going to bring these words about Warren Buffett. I mean, he says like, be fearful when others are greedy and greedy when others are fearful. Until now, most of the investors has been making this mistake. I mean, it's like they are just going like the market is going up. Oh, I don't want to feel the fear that I'm not being part of the group. So, and you just go and buy there. And Warren Buffett is telling us it works the other way around. It's like when the market is going down, when the situation is like cheaper, of course, always consult with your financial advisor. If I am your financial advisor, remember, we can discuss your case, I mean, particularly for each one of you. But I would say like when the markets get red, when the things doesn't look right, that's when you shall be getting into the market for the long run. And also in these days, maybe the situation feel like, oh, I should be investing my money, maybe not in the USA. I should be taking my money outside. When you start reading all the news, it's like, where are you gonna take your money? I mean, to China, the situation in China is not that better. Or you will say, I'm gonna take it to Europe. In the situation in Europe, they have this inflation, these problems, this deficit, and all those different kind of things. And then what else? Like India, Brazil. I feel like Warren Buffett also told us, like, he always said, like, never bet against America. And the reason why is like, yeah, this is, I mean, one of the countries with the biggest consumption, I mean, the biggest economy in the planet. So be careful when you're thinking about as a diversification will be okay, but saying, oh, I don't want to invest more in the USA. So where are you going to invest your money? Okay. So if we go for the second mistake will be here, ignoring diversification. And always ask yourself, is my investment portfolio diversified? I'm bringing this example here because I have some clients or some friends or people that sometimes ask me, oh, I have a really diversified portfolio. And when you say, why your portfolio is diversified? Because I have like, I don't know, a few real estates in the same state, or I have like, I have 5 different kind of crypto assets, or I have most of my companies, I mean, the individual stocks that I'm buying are from the technology sector. That's not diversification. That's just like having 2 different sodas from 2 different brands, like Coke and PepsiCo, and you're just having the same. Whatever happened to that sector is going to impact your portfolio and your investment. That will not be a real diversification. Remember, diversification is having things that move into different ways. For example, until now, in most of the years, not in some of the years in the last 100 years, but in most of the years, yeah, sometimes the stocks goes down and bonds goes up, and they move all the way around. Or sometimes, like I was mentioning before, the US economy is stronger, and maybe the economy from other countries is not, but it could happen the other way around also. So what I'm trying to say here is like, for example, if you're gonna buy a house here in Florida, and you have all your assets here in Florida, and you work in a company that is here in Florida, you are not diversifying. You want to have different colors in your portfolio. And when we talk about different colors in your portfolio, sometimes when I see my clients' portfolio, they look like this plain plate of pasta. You need colors. You need things that look different in your portfolio. Because if not, whatever else you're having in your portfolio will look just the same. So that's why a really diversified portfolio will look like the other pasta that we are showing to you here. It's something that has color. It has like, oh, I'm investing like all my money in the US market because Warren Buffett says that never bet on America. No, you also need some investment outside of the US. When the US economy is not doing so well, maybe the other economies are doing well. And that's why diversification is all about. That's what you're looking for in your portfolio, to have a really diversified portfolio. If we keep looking at here, I just brought this example because it's all over the news. It's like, oh, an investor that says, I'm going to just to buy Tesla, for example, a technology company. I'm going to have all my money in Tesla. Well, until now, in just for this year, the stock has been going down like more than 32%. That's not diversification. If you had the same money, but just in the S&P 500 for the same period, I just took this number for March 27, you can see the S&P 500 for the same year to date, the same period here. It has been going down for 3%. You can really see the difference. It's like, well, a diversified portfolio allow you to cushion that. I mean, you don't have those big volatility there, like if you're just having one particular stock. So second mistake there, be really careful to have a diversified portfolio. And remember, if your portfolio seems like that pasta, that plate of a pasta with the same ingredients, you're not diversifying. And if you just want to have like a portfolio that is going to grow in time and you don't have this stress for whatever is going on, remember, diversification helps you to reduce that risk there. If you have, by the way, if you have any questions, please let us know. You can just, type it in our chat and we will go for it. And if you have any questions, I'm not going to go for any political comment. My apologies. This is just a technical, webinar that we are just giving you the 5 top mistakes that maybe some of the investors are making there. Third mistake, trying to time the market. As we know, in our finance world, there is a phrase that it says like, time in the market is more important than time in the market. And that's why we are bringing this graph, from Charles Schwab, that shows like, you can see here the date range. It's like from 2002 to 2021, we have, 7,000 years, days there. You can see it's a really long period of days. But in that period, if you just said, oh, I think the stock market is going to go down, I'm going to get out of the market, I'm going to sell all my positions, and I'm just going to review the markets outside of this mess, And then when this uncertainty goes down, and then I'm going to go back. Maybe, and usually happens like that. Maybe you're just missing the best, I don't know, the best 10 days there. And as you can see in this graph, if you were investing in the S&P 500, and for all these days, you just leave your money there, annually, your return will be like that 9.5. As you know, this is just for educational purpose, and past performance is not indicative of future returns. But you will be making that 9.5% if you have that money for that period there. But if you just, said, I cannot hold this uncertainty, I'm going to sell my positions and I'm just going to be in cash waiting for a great moment. But maybe for those days, you miss the best 10 days of the market. Your return will go and it will be cut into half almost, yeah. And in the same period, if you lose the best 40 days, you can see here that your return will turn into a negative area. So what I'm trying to say here is, like, people usually don't see it, but when the market starts to go down, those are the days that this rubber start to, to stretch and stretch and stretch. And those days when the market is going down are the days when the market jumped the most there. So be careful with that. I know it feels like you're protecting yourself, but only for losing a few days, a few of the best days, your return could be really, really severely impacted there. I'm bringing also this report here. I know it's a lot of numbers, but I will try to explain these numbers here. Maybe you can feel that, oh, if I do this with a professional, he will be able to time the market. He will be able to say, I'm going to sell all these positions, go to cash, and something like that. There is a report from the S&P Dow Jones. It's called SPIVA. If you want to have it right there, just Google it, and it will be there. But this one shows, like, what is better, to invest my money in a regular index fund or an ETF fund that copies an index, or hiring one advisor that's going to use an active strategy. Maybe he will, be selling all the positions because the market is going down, and then he will jump because he will know the numbers. I'm going to go for this last column here. And what this last column is saying us, it's like, as you can see, for the biggest company, the S&P 500, the mid-sized companies, and the small-sized company, it says, like, in almost like 91% of the cases, these great advisors or financial gurus were not able to beat the market, the index. And it was way better just to be with your regular ETF fund paying a really low expense ratio. So what I'm trying to say here, not even the experts are good at doing this. If you are betting here, you have a 91% probability of not making it. So be careful with this one. Don't try to time the market, to stay in the market. It's way better just to hold. Don't read the news. I know it feels hard, but don't try to check your balance into your account. And if we go here for this quote from Paul Samuelson, it says, like, investing should be more like watching paint dry. I don't know, it's something more boring than that. Or watching grass grow. And he always say it, like, if you want excitement, take whatever amount you have and go to Vegas. That will be better if you're looking for excitement. What I'm trying to say with this phrase, and what Paul Samuelson is saying with this phrase, who was a really famous economist here in the US, is like, don't try to have an excited portfolios. Like we just reviewed it before. We saw what happened when you try to guess what is the winning horse or the winning stock out there. Be careful with that. It's not the best strategy to have. It will be way better for you just to stay with your investment and not to try to guess what is the best investment out there. So as we are seeing here, another mistake, the third mistake that some of the clients or investors are making, I will say, is trying to time the market because you cannot sustain the fear of what's going on. And the mistake number 4 will be, there is risk. And when there is risk, you need to have a recipe, a plan, and a strategy, what you're gonna do. And sometimes when I review my clients, portfolio, what we can see is that sometimes, like when I ask them, what's the strategy behind this portfolio? Oh, just a friend told me that I should be buying Nvidia, I should be buying the other stock. Okay, and how much you want to have in this particular stock? How much you want to have in international stocks? Do you have a recipe? And those who know me will, I always use this example about a cookie recipe. You want to know, like, how much flour are you going to use? How much salt you want to use? Because you want to build your portfolio in a certain way. It will be like, what's the speed that you want your portfolio to have? You don't just want a portfolio that will be drifting around. You want a portfolio that looks the way that you want to, be looking there. And the reason why will be that it's really important for you to have the opportunity to rebalance that portfolio. Rebalance that portfolio will be, well, you don't want to just check those ingredients in the future and just to see that now you have a cup of salt instead of a cup of flour and just a little, spoon of flour there. You need to have a recipe for in these times. You want to sell whatever is going up to buy whatever is going down. You want to sell high to buy whatever is going down. And maybe you can say, Alonso, but these days everything is going down. I would say it's not like that, but if we have to discuss it, I will be there are the things don't fall at the same speed. So maybe there's some of the stocks are falling faster. Maybe your bonds are not falling that fast. Let me show you another graph here, and this is an information from JP Morgan, and its importance of rebalancing. The same example I'm using here. Some of you can say, but do the ingredients move that much? If we can see here, this was 2020, a portfolio that if you have a portfolio of 60% stocks and 40% bonds, and before all these days that the market is going down and all that, if you take that information for January or something like that in 2025, and you just leave it there. You never touch it, you just leave it there, you never rebalance, you don't have a recipe. And now you check your portfolio in January of 2025. Your portfolio will look something like 80% in stocks and 20% in bonds. And maybe now it's going really fast and you don't want your portfolio to go that fast. So remember, always have a recipe, rebalance your portfolio. Don't care about the news, just rebalance your portfolio, care about the right recipe for your portfolio. And that will be another mistake that sometimes we see that some of the investors are making out there. Let me go for the final one here. And the final one will be, I would say that sometimes investors, they don't have a financial plan. And sometimes they just feel, why you're investing? Oh, to make money. Okay, great. And what you're gonna do with that money? Well, to have more money. Okay, and then what else? Because you're not, you're not Jeff Bezos, you're not, Warren Buffett, something like that. They could be worried about having more billions and things like that. But maybe regular people, we are used, maybe we are worried about retirement, college education, I don't know, buy a new house, leaving a legacy and inheritance or whatever is there. But I will say that your portfolio for each one of those particular goals, your retirement, should look like different kind of cars for different kind of destinies. And you should have a portfolio for each situation. For example, if you're already retired these days and you're worried because whatever is happening in the markets these days and whatever is happening in the economy these days, well, you should have like one different portfolio or a bucket with some cash. In these days, you can earn a really good rate in a high yield saving and with a certificate of deposit or something like that, with the money that maybe you're gonna need for the next 1 or 2 years there. So you don't have to be so worried for whatever happens into the markets. And also you should have another bucket for that money to keep growing to your retirement. And you don't have to be worried for that because that's money for the long run. When the problems comes, it's like when you have all your money in the same kind of bucket. And that's where you start to getting worried because maybe you're already retired and you have to start withdrawing money. And this is the worst time to start withdrawing money. By the way, if is that your case and you did not have this bucket for the short term, try to reduce your expenses for this year. Maybe it's not the year to buy that particular car or have that home improvement or other things. Wait until the market gets better and then go for your plan. So I will say uh, the way to get to your plan is always like have a goal, know where you want to go, what kind of portfolio are you going to use, and get used to. I mean, it's going to be hard. I mean, it's going to move. But if you have the right card with the right plan to take you to that particular destiny, you're going to be right. I mean, we have already seen all the numbers and how the market is moving there. Some of my clients says like, what about if the portfolio goes to zero? I will say that if you have a really diversified portfolio with all the biggest company in the planet, do you really feel that all those companies are never going to produce again? They're never going to have any kind of sale. Imagine all the different companies in your mind. If something like that will be happening, I would be saying to you, maybe you should not be so worried for your portfolio because that will be, the end of the civilization or something like that. So be careful with those kind of thoughts there, because sometimes when you don't have a plan and you're using the short-term money and it's invested for the long run, that's when the intuition start to happen. And here, I will say that be careful, because most of the time what happens here is like, sometimes we mix what is our personal finance with the economy. I would say when you really need to move your portfolio, it will be when your personal finances start to change. For example, both of you were working. Now one of you is not working because maybe the recession is coming. Well, then you have to reduce the risk of your portfolio. Not because something is happening in China or something is happening with Mexico. You cannot control that. The only things that you can control will be your personal finances. And remember, one of the best strategy will be to have a really good emergency fund. These days, you can take advantage of the really good rates that are out there. I mean, don't invest the money that you need for the next 2 or 3 years in the stock market. And if you do, try to look for a strategy to reduce that risk in case your personal risk is going up. If your personal risk is not going up, you're still working, you still have a good flow, don't worry about it. It's like, maybe these are great times. Talk this with your advisor, but maybe this is a good time to start investing in the market. If something is happening beside what you can control, that will be, something really complicated. I have a question here from Miranda. I'm just going to take it right away, Miranda. I'm just going to finish this one and I'm going to go for that one. If we sit it here, if you feel nervous and you want us to have a review with you, you can just schedule a free meeting with us and we can help you there. That's our web page. We can review your portfolio. And of course, thank you for all that. And now we can go for any questions that you may have. I'm gonna go for that one from Miranda. It's a wonderful question. She's asking us like, gold and gold mining stocks are going up. You're not a huge fan, wondering if you consider gold and any precious metal in your recipe. I will say that in these days, I like to buy things that are cheaper and not the things that their price has been increasing a lot, because as we know, the rule of to be a really good investor, a really good business person or whatever, is going to be always try to buy cheap to sell high. I mean, if you ask me, is the gold cheap these days? I don't feel it. I don't know if it's cheap, but what I do know is like the gold prices have been going up and up. You mentioned something that is really good. I mean, gold does not produce any kind of income. It doesn't give you dividends. No, it doesn't give you interest. It's just like a metal there. But the good thing about buying in these kind of things, try to go for something like a gold mining, because at least those are companies that are going to give you some dividends. Just to make these questions shortly, the answer to this question will be, I would prefer to buy things today that are going down, where I see an investment opportunity, and not to buy things that maybe a lot of people are selling because they are making more money for them. So I will say that. So I don't know if you have any other questions or suggestions for the next, webinar. We're gonna be having these webinars one per month. So we can share different aspects of whatever is on your mind in investment, tax planning, and different kind of things. Again, thank you for being here with us. So if there is no other question, just thank you and have a wonderful weekend then. Thanks. Thank you.